It's Wednesday the 15th, I'm FX Blue and this is CurrencyTransfer.com's market update. And the headlines today are that the data calls the UK rates hike into question, the dollar rally continues and the euro is driven lower by dollar strength. So yesterday's employment report showed that unemployment in the UK is at its lowest level since 1975. That's if you believe it. These figures can be easily massaged. The more believable data is that wage inflation has fallen from 2.5% in June to 2.4% in July. Today's inflation report is also unlikely to send sterling any higher, as headline CPI is forecast to remain the same at 2.6%. So what was the recent rate hike all about? Perhaps it was just simply to A, defend the currency, and B, provide a slightly higher starting point for if/when the post-Brexit rate cuts have to come into play. Who knows? But the data at the moment isn't really painting a supportive picture for the rate hike. Brexit remains the heaviest weight on sterling, but while the data isn't exactly exciting the market, it's unlikely that we'll see any rally for sterling even during this lull in Brexit rhetoric. Yesterday, cable traded down to 127.05 before closing a little higher at 127.20. Since the dollar index broke through the resistance at 95.25, it has showed little sign of slowing down. The continued meltdown of the Turkish lira is adding further benefit to that, as the flight to excellence, as it's called, is coming from emerging market currencies. We saw a high yesterday of 96.80 and gains have continued further overnight. There is a risk of contagion across emerging markets that could also spread into more developed markets with the direct link to Turkey. Germany, for example, is currently in the crosshairs. German stocks fell yesterday over fears that the German banks have too much exposure to Turkish borrowers. That's in addition to French, Italian and Spanish banks that were all caught up when the story originally broke. The ECB, of course, is providing no real encouragement for anybody to buy the euro, and with these other influences turning negative, the longer-term outlook for the euro is certainly very negative. But how far would the euro have to fall to attract the attention of the ECB? The wider view at the moment is that it's the pace of the fall as well as the ultimate level which would need to raise concerns. Current suggestion is that if euro-dollar tests the support seen around 110.80, it may trigger reaction. Some way to go on that, but it's certainly something to keep an eye on. For now, euro-dollar's trading at 113.30 and sterling euro is touching 112.10, so it's comfortably above those levels at the moment. If you've got any questions, please do pop them in the comments below. Otherwise, I'll see you tomorrow.